What if the biggest mistake in life insurance is not buying the wrong policy, but believing the sales pitch before you understand the math? Because when an agent says, whole life builds cash value, it sounds smart. And when someone online says, just buy term and invest the difference, that sounds smart too. But both ideas can be dangerous if you don't know what's really happening behind the numbers. Imagine two dads in their 30s. Both have a wife, 2 kids, a mortgage, and the same fear. What happens to my family if I'm not here anymore? The first dad, Jake, sits with an insurance agent at his kitchen table. The agent explains whole life insurance. It protects you forever. It builds cash value. You can borrow against it. It's not just insurance, it's an asset. Jake feels responsible, so he signs. His premium is around $450 a month. The second dad, Marcus, buys a 30-year term life policy. Same $500,000 coverage, but his premium is only around $35 a month. Then Marcus takes the difference, over $400 a month, and invests it. Same goal, same family protection, very different outcome. Here's the first thing agents don't always explain clearly. Whole life insurance is permanent, but it is expensive because you are paying for insurance and cash value at the same time. In the early years, a lot of your money does not go into cash value. It goes toward commissions, fees, insurance costs, and policy expenses. That is why many people pay thousands of dollars in premiums, then look at their cash value a few years later and feel shocked. The second thing they don't always explain is this. Your cash value and death benefit are usually not added together. If you have a $500,000 whole life policy and build $100,000 in cash value, your family may still only receive the $500,000 death benefit when you die. That cash value often stays with the insurance company unless you used it during your lifetime. That one detail changes how people see the whole product. Now, does that mean whole life is always bad? No. And this is where many finance videos become too simple. Whole life can make sense for some people, high net worth families, business owners, people with estate planning needs, or families with a lifelong dependent who will always need support. But for the average American family with kids, a mortgage, and 20 to 30 years of income protection needs, term life often makes more sense. Why? Because life insurance is not supposed to make you rich. It is supposed to protect your family during the years they depend on your income. If your kids are young and your mortgage is high, you need strong protection. But 30 years later, your kids may be grown, your mortgage may be gone, and your investment account should become your safety net. That is the real idea behind buy term and invest the difference. But here's the catch. It only works if you actually invest the difference. If Marcus buys cheap term insurance but spends the savings on restaurants, vacations, and random upgrades, he didn't beat whole life. He just bought temporary insurance and built nothing. That is the psychological trap. Whole life forces discipline. Term gives freedom. But freedom only works if you have discipline. So the real question is not, which policy sounds better? The real question is, what problem am I trying to solve? Do I need temporary protection while my family depends on my income? Or do I have a permanent financial need that lasts my entire life? Before you sign anything, ask 3 questions. How much coverage does my family actually need? How long do they need it? And what happens to the extra money if I choose the cheaper option? Because the worst insurance decision is not term or whole life. The worst decision is buying something you don't understand because someone made it sound safe. Protect your family, run the numbers, and never let someone else's commission become your financial plan. If this helped you see insurance differently, like the video, subscribe, and comment. Term or whole life, which one would you choose?